Welcome back to the deep dive. So, when you're trying to figure out if a company's healthy, you probably do what most of us do. You look at the earnings report, you see that big net income number, and then maybe you glance at the balance sheet.
That's the standard playbook.
Right. But if you stop there, you could be looking at a picture that's been heavily photoshopped.
That is a perfect way to put it. The income statement is absolutely crucial, but it lives in this world of estimates and assumptions, what accountants call accrual accounting.
It tells you when you made a sale, not when you got paid for it.
Exactly. And so for our deep dive today, we're focusing on the statement that cuts through all of that, the one that shows you where the actual hard currency went, the statement of cash flows.
Our mission today is pretty simple.
Yeah.
We want to stop treating the cash flow statement like it's some kind of optional appendix.
Yeah.
We want to start using it as the main tool for checking a company's financial health. We're going to get into why net income can be vanity, but cash is king.
And that's all because of accrual accounting. It's useful, don't get me wrong, for matching revenues with expenses. But it also gives management a lot of leeway, with things like depreciation schedules or inventory valuation.
A lot of wiggle room.
A lot. And the cash flow statement is the ultimate companion because it's just the impartial record. It shows where the money actually moved. It's the check you need against any potential bias in those assumptions.
Okay, let's unpack that with a couple of scenarios. I think we need to be really specific about where net income can lead you astray.
For sure. The sources we looked at really highlight two big areas. The first is with companies that have really high non-cash expenses. Think about heavy industry, manufacturing.
Like the big machinery.
Exactly. They have these huge depreciation charges that just crush their net income. So if you only look at the earnings, the company might look unprofitable or at least really pessimistic.
So on paper, it looks like they're struggling. But in reality, the cash from their operations is still flowing in just fine, because that depreciation expense isn't actual cash leaving the building.
Right. The operational cash flow gives you a much better and frankly more accurate picture of their performance.
Okay, but what's the flip side of that coin?
The flip side is where investors often get burned. The hypergrowth company. A company can be showing fantastic, skyrocketing net income, everyone's celebrating.
Of course.
But growth consumes cash. They're buying tons of inventory. They're giving generous payment terms to new customers to win business, building new facilities.
So they look super profitable, but they're spending cash way faster than they're collecting from all those new sales.
Precisely. They are cash constrained. They can be profitable on paper one quarter, and then suddenly they can't make payroll the next. All that profit is just tied up in inventory or in accounts receivable. It's not in the bank. The statement of cash flows exposes that imbalance immediately. It's the reality check.
So if this statement is going to be our reality check, it needs to be organized. It's broken down into three main sections, right? Three kinds of activities.
Yes, three mandated categories: operating, investing, and financing, usually just called O, I, and F.
Let's start with O, operating activities.
Operating activities are the core. They're basically all the activities that feed into the calculation of net income. This is the pulse of the business. Selling products, paying your suppliers, paying your employees, that kind of stuff.
And the bottom line of that section is net cash from operations.
Exactly. Then you have investing activities, or I. This is where a company is, placing its bets on the future.
Putting its money where its mouth is.
That's right. This is mainly about buying and selling long-term assets. We're talking about capital expenditures, or CapEx, buying new factories, selling off old equipment, purchasing land.
So a big negative number there isn't necessarily a bad thing. It shows they're investing.
It shows they're investing in growth. And the last one is financing activities, or F. This is all about how the company funds itself.
It's capital structure.
It tracks the cash moving between the company and its owners and creditors. Did they take out a new bank loan? That's a positive cash flow. Did they pay a dividend to shareholders or pay back some of that loan? That's a negative cash flow.
Okay, so you have the three pillars. But what happens if a major transaction happens that doesn't involve any cash at all?
That is such a critical point. The sources really stress this. There's a rule about disclosing significant non-cash investing and financing transactions.
Give me an example.
Sure. Let's say a company buys a huge new building, but instead of paying cash, they issue new shares of their stock directly to the seller.
So no cash actually moved.
No cash moved. But the company's long-term assets went up. That's an investing activity, and its equity went up, a financing activity. That kind of major structural change has to be disclosed, usually in the footnotes, to give a complete picture.
Got it. So if we step back and we're looking at a completed statement, what's a normal pattern for a healthy, growing company?
There's a classic pattern you want to see. A healthy, mature company should be generating a lot of positive cash from its operations. From O,
It proves the core business is working.
it proves the business model is sound and it can fund itself. And then that positive cash from operations is typically used to fund a negative cash flow from investing.
They're recycling that cash back into the business.
Exactly. They're constantly upgrading equipment, expanding. That's a healthy cycle. If you see a mature company with positive cash from investing, that's often a huge red flag. It usually means they're selling off assets just to stay afloat.
Let's pause on that for a second because this leads directly to maybe the most important metric from this statement. Free cash flow. Everyone talks about it. How does it fit in with O&I?
Right. Free cash flow is the true measure of financial flexibility. It's basically your cash flow from operations minus the capital expenditures needed just to maintain the business.
So it's the cash left over after you've paid for all the necessary investments, the money that's truly free for management to use.
Yes. It's what they can use for the optional stuff, like paying down extra debt, buying back stock, or paying dividends. If a company has high net income but negative free cash flow, it tells you that all their earnings are being eaten up just to keep the lights on. It's a much less flexible, much riskier business.
That makes perfect sense. So back to our pattern. Positive O, negative I. What does the financing column F tell us about a company's life stage?
The F column is a great growth indicator. For a really mature company, that column might even be slightly negative. They're generating so much free cash flow that they're using it to return capital to investors, paying dividends, buying back stock.
That's a good problem to have.
It's an enviable position. But a young, high-growth company would look different.
The one we said might be cash constrained.
Right. It might also have positive O and negative I, but it needs outside help to fund its massive expansion, so its financing cash flow will be significantly positive. That reflects cash coming in from new loans or from issuing new stock.
Okay, this is where we need to switch from interpretation to the mechanics. It gets a bit technical here. If you have a perfect record of every single cash transaction, this is easy. You just sort them.
Yeah, that's the easy way, but as an external analyst, you never have that.
Right, so you have to infer the cash flows by using the other two statements.
This is where that idea of articulation comes in. The financial statements all tie together. So you can figure out the cash movements by analyzing the changes in all the non-cash accounts on the balance sheet from the start of the year to the end.
Wait, hold on. Why do you need the balance sheet to calculate operating cash flow? I thought the income statement was for operations.
That's the million-dollar question, and
Yeah.
it's because the income statement is accrual-based. We use the changes in the balance sheet specifically in things like accounts receivable and inventory to reverse those accruals and get back to a cash basis.
Okay, so if my accounts receivable went up by $1 million.
It means you booked $1 million in sales revenue on your income statement that you haven't actually collected in cash yet.
So my net income number is overstating my cash by $1 million. I have to subtract that change.
You've got it. That subtraction is the adjustment. And doing this for the whole statement is a really careful, sequential process. There are about 6 key steps.
Okay, what are they?
First, you compute the total change in the cash balance. That's your target, what you're trying to explain. Step 2, as we just discussed, is converting the income statement from accrual to cash to find your cash from operations.
Right.
Step 3, you analyze all the long-term assets to figure out the cash effects of investing. Step 4, you do the same for the other side of the balance sheet, the debt and equity accounts, to find the financing cash flows.
Then you just put it all together.
Step 5 is preparing the formal statement. And the last step, step 6, is you circle back to that crucial disclosure of any significant non-cash transactions. The process makes sure every single penny is accounted for.
Okay, let's focus in on that operating cash flow section, since it's so important. The sources mentioned 2 ways to present that part, the direct method and the indirect method.
The direct method is, well, direct. It's very simple to read. It just lists things like cash received from customers and cash paid to suppliers. Easy to understand.
But you almost never see it used. We always see the indirect method, which starts with net income and then has a list of adjustments. It's way more confusing. Why?
It is more difficult to grasp at first, but it has way more analytical power. By starting with net income and then explicitly showing the adjustments, adding back depreciation, subtracting the increase in receivables, it turns the statement into a diagnostic tool.
It shows you exactly why your profit doesn't match your cash.
Precisely. If net income is, say, $200 million, but you have to subtract $150 million because your receivables ballooned, the indirect method instantly flags that 75% of your earnings are trapped in uncollected invoices. You don't get that insight from the direct method. It shines a bright light on the quality of the earnings.
That is an incredibly important distinction. All right, let's shift gears now to the future. We've been talking about looking backward,
Yeah.
but the real power here is using this knowledge to plan ahead.
Absolutely. The forward-looking version of this is called the projected, or pro forma, cash flow statement. You build it by taking management's best guess for the future income statement and balance sheet and applying that same logic we just walked through.
So this is how a company can see a cash crunch coming months away and do something about it.
Exactly. Internally, it is a cornerstone of corporate strategy. It lets a company plan the timing of when they need to go to the capital markets. If the pro forma shows a big cash shortfall in 9 months because of a planned expansion,
They know they need to get a loan or issue stock before then.
they know exactly when. And on the flip side, it tells them when they'll have enough extra cash to maybe do a share buyback.
And externally, this projection is obviously vital for anyone thinking about lending money to this company.
Oh, it's irreplaceable. A potential lender will use that pro forma statement to see if the company is likely to generate enough cash to repay the loan. It's how they check if the company will violate any debt covenants. If the projected operating cash flow looks weak, the deal is off.
And for potential investors, it's about their own wallets.
Of course. Investors look at it to see if future cash dividends are likely, or if the company can really afford that big stock buyback program it announced. The pro forma statement is the key to seeing if a company's big plans are actually consistent and, workable.
That really brings us full circle. The statement of cash flows isn't just some form you have to file. It's the ultimate tool for strategic planning and for anyone on the outside trying to see the real picture. It keeps the fantasy of accounting from clouding the reality of cash.
I think the final thought for you to chew on is this. True understanding doesn't come from mastering any single financial statement. It comes from understanding how they're all connected, how they articulate. Knowing how the income statement, balance sheet, and statement of cash flows all tie together is the only way you can really forecast how a decision made today will impact a company's financial health down the road.
So the next time a company announces a huge profit, don't just stop there. Go find the statement of cash flows. See if that profit is actually being turned into operating cash. Because if the earnings are high but the operating cash is low or negative, you might be looking at a company that's reporting success but is actually walking straight towards a liquidity crisis. And that's the real story you need to find.